Hello and welcome back to another episode of How to Trade Stocks. Another boring episode where we dive into spreadsheets, and look at what really matters. Not the flashy, colorful charts, not the colorful buttons, but actual data and what the difference is between an actual trading portfolio or two actual trading portfolio, but the benefits of one versus the other. That's what we're talking about here today. Let's dive right in. We're going to open up our browser, and we're going to start off today with the long and short portfolio manager. What I've been doing here, if you've been following the channel for the last month since I started recording again, we've been tracking the status of long and short portfolio and all the trades that go in it alongside the long only account value. The video today will be about comparing the two and the results over the last little while. As you know, we started recording on January 7th. It's been just about over a month. I'm doing these updates every single week to keep you informed as to what's going on. If you're here for the first time, none of this will make sense, but just try to truck along with me. Um, this sheet that you see in front of you, I've only been using this year. This is a brand new redesigned portfolio manager, and this is what I'll be using forward. Um, what I'd like to talk about today is the long and short value versus the long only value and how it's performed over the last couple of weeks due to the volatility that's been in the market. I also note beside what I'm doing on any particular day, you see these thicker lines, they separate the weeks. So this is 1 week, this is another week, another week, another week, and this is the week we just completed here. You can see I've been saying a lot about volatility. There was the sell-off last week. The week prior to that, there was a Microsoft sell-off. There was a Fed chairman nominee announced. A lot of stuff happening, but if you do this the way I'm trying to show you, this is the way I've learned how to do it, you will not only survive these shocks, you'll have a much lesser drawdown. That's about to be revealed right here, or in this section actually. The overall long and short portfolio profit and percentage for the long and short and long only can be seen right here. Long short in this month and a week or a little bit returned almost 26%, whereas long only portfolio returned only 4.43. If you look at their actual value, we're looking at 1320 on the long short and 1193 on the long only. What does that mean? This is the return on the exposure, the amount you're actually investing. How much am I investing? You can find that all up here. And my long exposure is 7,632. My short exposure is 72,769 for a combined of 14,901. My long only exposure, it's 21,443. But if you go down here, the long short account value is at 65.53. It's not 14,901. This one here, it's that's the actual account value for long only. You can see that my exposure is 21, so I got about $7,000 cash in there. But my long only exposure, it's only one way. It's just if the stocks go up. Here, the stocks go up and they go down. Why do I have almost $15,000 worth of exposure on an account which only has 6.5 grand in it? That's because this is a margin account. A margin account allows you to short stocks, unlike the long only account, which is a tax-free savings account for those of you living in Canada. I guess in the States you have something called IRAs. Pretty much, I won't have to pay any tax, capital gains tax on this account. And so I have an account which is long only. Mind you, this is a very volatile account due to the fact that it's exposed to all these market shocks. The long and short account doesn't have these crazy mood swings because it's hedged against these market shocks. as I'll show you in a moment. So boring spreadsheets, but unless you do it and look at this and then design your own, copy me, I don't really care. Maybe I'll post this for you guys to download and you can use it. But the best way is to learn how to put these things together on your own by following somebody else and eventually coming up with something for yourself. I literally put this thing together by myself using AI. There's a lot of formulas and scripts running in the background. You see like this chart here is constantly changing. That's because the scripts are constantly updating the numbers, the latest numbers that are coming up. And as you can see that it's doing that again. It actually updates every one of these lines every 5 minutes. So I just always have to up-to-date numbers. So we already talked about the ROI on the long short, 25.79, and ROA on the long only, 4.43. Now imagine having as much money in the margin account as the long only account, 28,000 versus 6,000. That's more than 4 times as much money. If I were to put all my money in the margin account, I would have had 4 times the results. 4 times and a little bit. So my $1,300 would almost be $6,000 at this point in time, instead of it being 1,320. Meaning my exposure in the long only is 4 times higher than the actual long only account. Like you look at it, long only value 28,000. This one is 6.5. Yet this one is producing better results, 25.79% point loss. Another thing I want to bring to your attention is just how volatile they are. So January 7th, when we started recording, both of these were at 0. And this is their performance ever since. So the first week, second week, every one of these lines is the end of the week. Just take a look at what's going on. By the end of first week, long short was up 12.9%, whereas the long only was up only 3.5%. By the end of week 2, long short was up 17.5% versus 5.5% on the long only. And I know what you're gonna say. It's like, hey, but this is only $888, and this one's already at $1,500 after 2 weeks. That's all fine and dandy, but imagine this being multiplied by 4. And how much bigger is this number already? That's over $3,000 right there. It's like $3,500. Continuing on, we had the beginning of the volatility. Both accounts dropped from 17.5% to 11.5%, whereas the long only dropped from 5.5% to roughly 1.5%. Week following that, because of this tech sell-off and the volatility continuing, the long only has gone from 13.5% to 17.5%. Somewhere during the week, it was at 22.2%, whereas long only went from 3.5 to minus 1/2 to plus 451. But just look at the trough over here. And that can only be represented by a chart that I'm about to show you. But I'm going to have to move this guy out of the way. Let's just put him up here so you can see all my notes. Look at from the highs to the lows. So our high for long only was 2,082. And the next week, it was at minus 172.68. That's over a $2,000, $2,200 drawdown. Same time, 901 to 485 on the same day. That was still up 9.5%. And then the following day, because volatility works mysterious ways and goes up and down, the following day we were up 17.5% already. Moving right along to where we are right now, long short is sitting at almost 26% return, which is the highest, and the long only it's sitting at 4.43. We're actually seeing a larger monetary result on the long short versus the long only. Now imagine this number again being multiplied by 4. And that's the difference of margin versus long only. But margin, you're exposed to paying the capital gains tax. So whatever gains I have over here, I will inevitably have to give it back to the government. Now, in Canada, that's roughly 24% of everything. So 24% of 1320 is what's going to be taxed at the end of next year, unfortunately. Anything that's in the TFSA stays. The reason I'm doing this chart and I'm showing you long, short, and long only is to prove a point that hedging, which is long and short trading, is the way to go. It's much more stable, definitely volatile, just like everything else, depending on what your exposure is to. But overall, it's a winner versus the long only portfolio, which is subject to major corrections every time there's a shock in the market or major news. Hedging gives you a little bit of, I guess it lets you focus on things that are more important in this instead of sitting there and watching the screen. You're focusing on finding the next best trades. I have 15 trades in this portfolio. This is what you see here is a representative of my long short portfolio, my long trade, and the short trade. TIGO versus CCI. This is the long, and that's the short, and these are the overall results. And if you've been following the channel, you know what the spread is all about. It's simply the distance between the two spreads. And as long as it's positive, you're making money. As long as it's negative, you're losing money. The reason I do this way is because stocks go up and down, but profit should only go up. And as you can see, this negative 14, negative 12, negative 10 here. Would I be closing these? Not really. They're very young. They're just over a month, and they need to be given time. If you look at anything that's older, this is the age of the trade in days. Anything that's older, they seem to be all in the green. Whereas anything that's shorter, they just need time to play out. And that I'm giving it. I'm not closing those accounts. There is a trade I will be getting into with you in a moment that I will be probably liquidating on Monday. And there's also another thing, which is a looming thing we need to talk about as well. I have an indicator which is showing me that there is a reversal, not so much a reversal as a reduction in the long positioning in the hedge funds, like all the big guys, where they're placing their money. And that's this indicator here that I put together myself. And this tracks the positioning momentum. Are the big boys positioning up, or are the big boys positioning down? And it looks like we have a reversal on our hand. We have a 37.5% reduction week over week. This number here comes in on Thursday, and it's updated automatically every single Thursday. This is this week's, and it's showing me that the momentum is reversing. When this goes into the negative, I will be liquidating, closing off all my long only portfolio trades. That is to protect the capital and keep it in my pocket. If this goes negative, there are usually lengthy shock, not so much shocks, lengthy corrections every time this goes into the negative. The herd itself, if you look at this other indicator on the right side here, the herd itself, it's actually confirming that. We are starting to see the dark side, even though the big boys are still showing the biggest amount, they're going up. Like anything up here, stocks are going up. Anything down here, the stocks are going down. Big boys, like this is the herd, this is the entire market. This here represents the big companies, anybody over 100 billion. And we can see that the vast majority is up top, but we're starting to see bigger numbers down here, whereas their numbers were really low on the bottom. Now we're starting to stack up. If you look at the big magnificent seven, the fat cows as they call them, they're all starting to go down. They've been going down for a while, but you can see that dark line is going near the bottom. And this is a potential. This is all the tech stuff. There's obviously been a major sell-off, but they also represent something like 30 to 40% of the market because it's just the scale. They're in the trillions, companies that are in the trillions, not billions anymore. And yeah, they push the market around when they jump around. So if I see this thing go more than half or go below zero, I am definitely liquidating the long only because at that point in time, I'll already be losing some money on that. But this here is my confirmation of that. If I see the big boys positioning, the banks, hedge funds, mutual funds, this tracks them here. If I see this thing and it's been going negative ever since January 21st, and all the volatility, obviously, you know, but I've seen days where this reverses and it goes back up, and then it's a nice rally. So really, what I'm looking for is that crossover zero into the negative territory, and that's my confirmation that I need to get out of my long only portfolio. And why would I not get out of my long short portfolio? That's because the risk is hedged out somewhat. It's not fully hedged out. There's still going to be volatility. But at the end of the day, a long and short portfolio will preserve your capital. And so, with all this volatility, the long only portfolio, it's been up and down, but overall it's up, down from its highest of 7.73 down to 4.5, whereas 25.17 to 25.79, the long and short portfolio literally stayed the same in the same time. So instead of losing money, you're preserving capital by using this method, and that's long and short. And you're trying to capture the difference between the two instead of just gains on one or the other. And another thing to mention is that you cannot put all your money in one basket. I put my money here on this account in 30 different baskets. Sorry, let's call them 15 baskets, 30 different trades. It's always long and short. You never trade just one direction because if there's a spike in the price, if there's a correction in the price, you'll feel these shocks just like on the long only portfolio. Why do I still have it? I don't like to pay taxes on my gains, and if I can help it, I'm going to push it that way. And it's been working. You just got to keep in mind that when the positioning in the market reverses, you don't want to be left standing there and holding on to your shares. You got to liquidate and you got to reposition, sit on cash for a little while. But this little indicator, the ranges, or aka beast as I call it, it shows me one, volatility is above 40, VIX is in the 20s, S&P's been bouncing off the top. This is a potential reversal, but I will not, and I repeat again, I will not reverse anything, close down anything until this becomes negative. And yes, I could start up here, but if you notice, before it goes negative, any numbers above, they're still positive, meaning the positioning is still up. The momentum is reversing. There's less and less buyers and more sellers at this point in time. But unless it goes negative, that number doesn't really affect the markets the way negative numbers would. And so I'm waiting for that. And week over week change was 37% in the negative. When I see this number in the hundreds, 200, that's a 100% confirmation. Do something before you lose all your money. In the long only portfolio, it won't be all, but it will be a big shock and you could lose 25 to 30% just like that. I've added one more markup here, one more thing to the spreadsheet since last week, and that's the change today. And this just gives me what the change on the day was. Combined portfolio value is at 34,649. Let's go over a couple of trades that happened. I guess Monday, I covered my IP short. I lost $57.39 on that. And to replace it, I sold two hubs at $232.21. So I replaced this IP trade with this trade. On Tuesday, I covered 9 HUT at positive 60.29. And you can see the same numbers showing up right here. Whenever I close trades, you'll see like whether it was a negative trade, it was a positive trade on both sides, long only and short only. And these are the results of closed trades over the month and a half that we've been doing this. So on Tuesday, we covered 9 hut, and to replace that lat long, uh, that should be, that should say long, just to keep things organized and easy to understand. We covered 9 hut at $60 profit, and then to replace it, we bought NTOIY at $12.70, 17 cents. And that's this trade right here. So this is the replacement trade. And so far, since, oh, this is definitely, when did we open that? I need to update the spreadsheet. So we opened that on the 10th of February. I need to update that. That's definitely not that old. That's still got the old numbers. February 10th. So this trade has been open for 5 days and is so far making $4.29. Not enough time. These things take time. You have to wait 3 to 6 months, sometimes a year. The idea is to put your money on something that will allow it to grow. And so if you look at Adobe, after $229 being my short in this trade, in 229 days, we are returning 32%. That's not even a year, and you're getting 32% on your money. So if I wait a year on the NTOIY, which is Nesty OEJ unsponsored ADR, this is a company it's a foreign company that they're listed on the U.S. stock exchange. So that's one. There was one here which is not performing so well. I forget which one it is now. We're gonna go quickly through all of them and just every single week I'm gonna give you an update on what's going on in a portfolio exactly. TIGO CCI, Millicom versus Crown Castle. This is doing 6.5 risk return percent already. New Gold Backs, we're down to minus 6.46. This one's been correcting a little bit, but as you can see, it corrected and it's climbing back up. Right about here last week, I went and I bought more when it was really negative. I still don't see a major reversal, and until I do, you load up instead of running for the forest and hiding. You load up every time the market is down. You try to get rid of things or cover them when the market is up. It's the opposite of what most people do, but this is exactly what Warren Buffett teaches. Be fearful when others are greedy, and be greedy when others are fearful. And that holds true for everything I've done so far. People always get out at the wrong time when they're losing money, and they close stuff when they're winning money. It just makes no sense sometimes. Village Farms versus HubSpot. Both are just over a month old, negative 7.5%. This is a potentially something that could be closed, but if I look at spread, the spread, yeah, it's struggling a little bit, but it's overall it's up. So I'm going to give this one a little bit more time. Celestica General Mills. This one corrected a little bit as well. This is the one I'm actually considering closing. The spread seems to be sideways, and not only that, it's finding new lows always. This trade, I made some really good money this last year on Celestica, but now it seems like it's topped out and it doesn't want to be going any further. So I might be replacing this trade altogether. This General Mills doesn't seem to be going down. Maybe I'll give it another week. Maybe I won't. It's not yet minus 10%. The spread is at minus 10, but I'll give it a little bit of time because these are only just over a month old, so they need to have time to play out sometimes. But I don't like what the spread is doing. I thought it would be, going up from here. Instead, it seems to be finding new lows, and that's not necessarily the best thing. So this here, Celestica General Mills, I may be closing that coming Monday, Tuesday. Just an FYI. And then you'll see it in the summary. I'm going to reflect it. I'll jot it all down and show you exactly what happened. Barrick Gold, Barrick Mining, and Lineage. This one's doing really well. We added Barrick 88 days ago. That one's returning 15%. Lineage, which was added 229 days ago, is 11, almost 12%. But overall, this is a good trade. There was a major correction due to the volatility, but we're seeing a reversal in that and that the spread is continuing. So nothing to change over there. The one we just spoke about, Nesty and Adobe, we're looking at Nesty almost 1% and then Adobe 32%. And nice spread going up, this pink line here. Barclays and Flutter International. Flute, we only added 25 days ago, and that one is at 30% already. Barclays at 37. This is a really good trade so far. The combined is $359. You can see beautiful spread going up, up, up. The prices are drifting away from each other. It's exactly what you're looking for. Even though Barclays is correcting, the spread is still changing in the positive because the short is picking up the slack and it's increasing the spread. SSR mining and Roblox. This is one of the better. I think this is the best trade I have. SSR has returned 637 or 123% in 234 days. Roblox returned 15% in less than a month. Combined return $716. King Gold Cross versus Caspi. Another good trade. King Gold Cross 42%, Caspi 12.95. Nice increase in the spread, nothing to change here. Sienna versus Altasian 31%, 45%. Another very good trade. This is open for just over a month and I'm already risk return is 38% combined, $353. PDLB GoDaddy, Ponce Financial, not so great, down 3.5%. GoDaddy in lesser time is up 25.6% for a total return of $108 at 11.72%. Newmont is another gold miner versus Figma, 11 up, 22 down. Spread is increasing nicely. Beautiful trade again. How old are these? These are 30 days and 19 days. Leave them open. Grail versus Zscaler. After just over 2 months, Grail is down almost 2%. Something you close? Definitely not. Zscaler is up 20%. So overall, this trade so far is returning 9% at $81. Global Ship Lease, Americold Realty Trust. Global Ship Lease up 7.8. Americold down, up 20%. Meaning the price of cold, COLD, went down, but I'm making money because that's my short. Once again, the price is drifting apart, the spread increasing as a result. CDE, Core Mining versus Kraft Heinz. If you look at this, the Core Mining, like all the other stocks, this one here is KHC. Why is this one so high? F9, so if we go to F9, what is happening here? Ratio. Oh, it's because it's calculating the beta ratio. So let's look at how many we actually have. KHC, oh, that would be in a short. KHC, I have 16 shares. Let's go back to that. That is 16. Yeah, well, I'll figure out what's going on over here, but this exposure doesn't make any sense, or this risk here. I will be changing that. There's no time for that right now, but We'll go back to that in a week. You'll see it's changed. Not my spreadsheet is still in works. It's not 100%. It's everything is adding up nicely over here for some reason, and then it's just not on that one. I'll figure it out. I'll correct it, whatever my error was. But the idea behind this video was to show you the difference between long and short and long only portfolio and what the results over the last couple of weeks of volatility are on both. The hedge portfolio is actually up, whereas long only is definitely down. And that is it. Thank you very much for joining, for listening to this boring video. If you're joining me again, thank you very much. Don't forget to subscribe. If you're already subscribed, there's more stuff coming. I'm going to actually add a bunch of overlay where I can start drawing on the screen and show you exactly what's going on and what I'm looking at. And right now, I've only realized to turn on the cursor here so you can actually see what I'm clicking on instead of it just disappearing and nobody knows what's going on. But I will be moving forward with a little bit more visual stuff, just not something that I have to pre-manufacture. We're going to do it on the fly. I'm going to jot stuff on the screen while we're doing this. I have no time in my life. I have a full-time job, and I don't have time in my life to make slides and videos and try to make money off of it. I'm only doing this out of the goodness of my heart, and I want you to make money. You do not have to be a genius to do this. Anybody can do this as long as you have the basic fundamentals in place, and that's education. Do you have to spend millions of dollars on educating yourself? No. You can come back to a channel like this where in the future, moving forward, I will start describing more of the process. We'll go back and pick the stocks, actually pick them, the long and short. We have a couple. Let's go back to them. Let's see actually. Last week I did. We might as well open them right now and find out what they're doing. Let me just give me 1 second. I'll go open them up. So here we are. What you're looking at is Next Power and MSTR. These are the two trades that we've set up that we're going to follow. Next Power is 20 days old. MicroStrategy is 6. These are so far the results. One in 20 days and the other one in 6 days. 5.67% return on that trade. Anything to brag about? Definitely not. Let's just reduce this so you can see. But the spread, even though it's been a little volatile lately, the price action and the spread seem to be doing well. So I expect great things for this trade. Yes, I am shorting MicroStrategy. Everybody's been doing that. They've been going down, and I expect it to continue that way. Their financials are just horrible right now. And it's due to the fact that Bitcoin's going down. Obviously, most of their exposure being in that. VSCO, Victoria's Secret versus HubSpot. Victoria's Secret returning 2.6% in 23 days, whereas HubSpot has lost 4.85, a combined return of minus $11 and 1.37% to the downside. These are very young trades, and they need to be given time. So would I be closing anything here? Not yet. Look at this overall spread. You got to give this time to play itself out. And the prices are drifting apart just the way they should be. So by next week, this should already be on a positive. And in a couple of months, it will be in the hundreds. But if you don't believe me, come back. I will definitely be coming back to these trades so you can follow along. Every week on the weekend, there'll be an update moving forward. This channel is going to be reactivated. And I'll share everything that I know overall. We'll actually start going through the details of choosing and deciding whether something is good or bad. Right now, I've just been focusing on the bad stuff. Get some of your attention, hopefully. If you don't find this stuff interesting, if you find it boring, don't trade because you'll lose your shirt. You have to do things this way. You have to be able to look and figure out what's going on within your portfolio on any given day. Why I do this? Because you could be up 200% on a trade, and then before you know it, that trade's going to reverse on you and be in the negative in a matter of a couple of days. And you won't know what happened because you're not tracking any of your performance. And it's not like your broker is making that easy to follow. Yeah, they'll give you the overall account picture and show you, oh, you're actually making or losing money. But which trades are making that happen? Which ones? How do I follow these colors and what do they all mean? Where are the opportunities in this? I've covered this in the last two videos, so go back to those. They're all from beginning of February, end of January, anywhere between January 7th to now is when I started uploading these videos again because there was inactivity for 4 years. Like I said, I got a full-time job. I uh, I want to share, but I don't have time for this always. Right now, I'm in a sharing mood. If you want to learn something, subscribe because there's a lot more content coming. And I know it's boring, but this is how it's done. And you do not absolutely have to be a genius. They make it look like it does by using terminology you've never heard of. I mean, on TV or online, making it seem like who knows what you need to make this happen. But it's a fallacy. All you need is a solid base and numbers. Numbers are your friend in this game, and if you do it this way, you will be profitable. You will preserve your capital instead of blowing it on a single trade, like most of the people out there, because they're taught to trade like a dummy. Put all your money in one basket and hope for the best. And yeah, sure, there's a lot of people that will be profitable that way because they get lucky. And believe me, that's all it is. It's lucky. Either that or they're doing something illegal, which they shouldn't be, and they could go to jail for that. But there's a way to consistently make money, profit in the markets, and that's called hedging. And that's what I'm trying to show you with this long and short portfolio, that no matter what happens in the market, you can still stay up. And this number should just keep on growing. Will there be some volatility in this? Yes, just like the long only, but look at the results. We're in a single digit still in the long only, whereas an account, which is 4 times smaller, is giving you a bigger return than the one that's $28,000. Just think about that. Why do I have both? One, I don't pay taxes on, and the other one is the moneymaker. So we'll see this account grow this year. And if you don't believe me, just go back a few videos. You'll see it. You'll see it for yourself. Anyway, thank you for joining me. I'm going to go back to enjoying my Sunday now. Sorry, you're right here. I will go back to enjoying my Sunday. We'll see you back next weekend, and I'll give you an update on what's happened. But thank you very much for joining. Don't forget to subscribe. Click that bell button or whatever. Give me a likes so that more people can see this because like when somebody comes out and shares stuff that's actually worth something, nobody watches. That's the scary part. Nobody wants to watch these boring videos, and that's how they lose all their money because they focus on all the shiny stuff, all the trickery on the internet to follow charts, be a daytime trader, sit in front of a computer 24/7. I sit in front of the computer maybe 20 minutes a day. That's it. I have a life to live. I have a job to go to. I can't be sitting in front of a computer, which does not help you. It affects you, it affects your family, it affects your relationships, it affects your friends. Eventually, you become a dull guy, and unless you give it up, that's all you're ever going to look at is charts. Do not look at charts. That's the very last thing you should be looking at. Fundamentals, fundamentals, fundamentals. And if you stick around, I'll teach them to you again. They're all there. 4 years ago, I've shown you guys like how to trade something for free, how to pick these stocks. There's sources online that will give you all this information for free. And ever since then, I've graduated to Seeking Alpha because they have a beautiful, beautiful format on how everything is organized. It's just like a newspaper to me, and I love, following Seeking Alpha and finding my trades that way because they have one of the best screeners on the market. But this works. God bless you, and we'll see you on the next one. Have a good day.